Sharp recovery on the street with the Nifty more than 200 points higher. Let's quickly look at how the Nifty is shaping up for you. We're in the green and we're seeing a very decent move on the Nifty 50 index. In terms of what's driving that move and some of the sharpest gainers of the day, honestly, it's the breadth. That's point number one. But it's also some specific counters. Coal India is up 3% in trade. Tata Steel up 2.25%. Trent is up 2% as well. Asian Paints, it's a stock which has done very well through last week, is up another 2% in trade today. A JSW Steel, a Hindalco, it's on the metals counters which are essentially standing out in trade today. What we'll do is slip into a very short break. On the other side, we'll continue coverage here on. Okay, before we slip into the break, let's quickly have a look at how the indices and how the street is doing. Sharp recovery, as I did mention, with the Nifty more than 200 points off the day's low. However, broader indices remain in the negative territory and the VIX stays about 7% higher. Metals see robust gains with FMCG and banks lending support. Real estate stocks stay under pressure. The new United States ambassador to India, Sergio Gore, touts the friendship between Donald Trump and PM Modi. Says India remains a very important partner for the US and he hopes to move forward on trade talks with the next meeting scheduled tomorrow. Lemon Tree is soaring after it approved the demerger of Fleur Hotels to create two focused platforms. Warburg Pincus will acquire APG's stake and invest 960 crore rupees in Fleur, which will list itself as a separate entity within 12 to 15 months. Q3 season for Nifty 50 counters officially kicks off. TCS expects to point a modest revenue growth and stable profitability with constant currency growth seen at just 0.5% and margins facing pressure from wage hikes and furloughs. In contrast, HCL Tech is expected to post stronger sequential growth and margin expansion. Retail inflation for the month of December is expected to edge up to around 1.5% on year, marking the second straight monthly increase, led by a broad pickup in food prices. Core inflation is also seen rising, partly due to higher gold prices. December will also be the last CPI print under the 2012 base year. Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsaita. Very quickly on to all the stocks that are moving in trade. In terms of points contributors on the Nifty, you're starting to see an uptick with regard to an ICICI Bank, which was languishing in the red earlier today. If we pull up that chart, you'll likely see the kind of move ICICI Bank has made. Very strong move from 1392, which was the day's lows. We hit 1424. So a very strong move where ICICI Bank is concerned. Outside of that, Infosys, Bajaj Finance, L&T are just some of the casualties, if I can call it, the top contributors among losers in trade today. 1% lower on Infosys, clearly pain visible within that pocket. In terms of some of the other gainers, and I want to talk more sectoral because that will give you a sense on why I am speaking sectoral. The Nifty Metal up 1.5% in trade today, 0.5% higher on the FMCG index. Nifty Realty is down nearly 2%, so some pressure coming in there. The Nifty Pharma is down 0.7%. So among the larger indices, sectorally, those are the big movers. Let's pull up the Nifty Metal and try and analyze that better. Try and get a sense as to which the big movers are. I'm sure a Tata Steel is one of them. Let's pull up a Tata Steel. Let's pull up a JSW Steel. Those are just some of the movers on the Nifty Metal Index. But a 1.5% move looks solid and sharp. Outside of a Tata Steel, JSW Steel, you'll also see a Hind Copper, a Hindustan Zinc, a Vedanta, a SAIL. All of them are moving with regard to the Nifty Metal, and that's what's aiding the metal counters higher. The Nifty PSU Bank absolutely flat, to be honest, so no real move there. But outside of that, we spoke about Pharma as well. So that's the other set of stocks which are doing well. In terms of the advanced decline, well, the tilt is firmly in favor of the declines. The advanced decline is looking increasingly difficult. So that's not looking like a very pretty picture either. So The advanced decline not looking good. 0.5% low on the Nifty mid-cap. The Nifty 500 basket also seeing some bit of pressure, largely because of the breadth. The advanced decline even there is looking very, very tough. Some of the losers within the broader markets, you'll see Tejas Networks down 11% on the back of the numbers that came through. GVTND is the other one, down 6. Signature Global down 6. Again, on the back of the numbers that they came out with and the commentary that they won't be able to meet their FY26 pre-sales guidance. City Union Bank is down 5. Maharashtra Scooters is down nearly 5%. Prestige is down 4. Lotus is down 4. So you're seeing some pain within the broader market pack. Among the gainers, there are, again, a few gainers there. IFCI is perked up 13% in trade. Force Motors is up 6%. BSE is up 4%. Hindustan Copper, Irida, Hindustan Zinc, Linde India, Manappuram Finance are just some of the big gainers in trade today. But let's talk a little bit about geopolitics before we get back to stocks. The new United States ambassador to India, Sergio Gore, touts the friendship between Donald Trump and PM Modi. He says that India remains a very important partner for the US and he hopes to move forward on trade talks with the next meeting scheduled tomorrow. Listen in to a slice of what he had to say.
We are raising the standard for diplomacy itself. That means fair trade, mutual respect, and shared security. Many of you have asked me for an update on the ongoing trade deal negotiations. Both sides continue to actively engage. In fact, the next call on trade will occur tomorrow. Remember, India is the world's largest nation, so it's not an easy task to get this across the finish line, but we are determined to get there. And while trade is very important for our relationship, we will continue to work closely together on other very important areas, such as security, counterterrorism, energy, technology, education, and health.
Okay, we'll stick with this because it's one of the reasons why markets have moved and made the kind of move that they have. The kind of statements that have come through, conversations will continue. Well, do we get a resolution tomorrow or do we wait another month is really the question. But it seems like the direction in which the comments are made, a resolution will likely come through, which is why you're seeing the kind of move on the Nifty 50 that you are. But broader markets not seeing that, and that's the other piece of concern. But let me go across. Sumita Karir joins in to discuss the context of the comments made by Sergio Gore, or rather Ambassador Sergio Gore, and what this means for future ties, especially after the tensions between the two nations and Trump continuously threatening higher tariffs. Sumita, what does this mean?
That's right. U.S. Ambassador designate to India Sergio Gore assumed office today, and in his inaugural address, he underscored the relevance of the U.S.-India partnership. He said that India is one of the most important partnerships that the United States has in the world, and there is no other partnership that is more important than this one. He also stated that he's come here with a mission to expand this bilateral partnership. This is going to expand across areas, for instance, in health, education, trade, technology is going to be another domain that the U.S. is going to be looking at, and energy as well as far as this partnership is concerned. Sergio Gore also underlined what Marco Rubio said. He quoted Marco Rubio and he said that 2026 is all going to be about trade deals. It's going to be about reciprocity and it's going to be about mutual respect. So that really underlines what is going to transpire all of 2026. The U.S. is going to be, it will continue to protect its interests. It will continue to be a tough negotiator wherever it feels it needs to sort of, put a strong foot forward in national interests. The other thing that he said that the United States is going to be welcoming India to the Pax Silica initiative. That's a critical minerals initiative that was announced last year. So overall, what could be expected from his visit? Well, a trade deal, he said the negotiations are currently on, and tomorrow is when the next set of talks are scheduled for. But what's important to note here is the fact that how trust will be rebuilt between India and the United States. And of course, Sergio Gore, in that matter, in that aspect, his role is going to be key as far as the communication of critical messages between Washington, D.C. and New Delhi, as far as that aspect is concerned.
Thank you so much for that, Sumita, that perspective. Kunal, it's a big one. I mean, just a statement is what has led to whatever's played out in markets. I wonder what happens if the trade deal actually comes through. And I mean, this is when fundamental analysts are calling that even if the trade deal were to come through, it's not a very big deal because it doesn't in any material fashion cause an uptick to earnings estimates. But just the sentiment is visible on the street.
So I agree to your first part and I disagree to your second part, Harsh. Let me put it in a very simple way. I agree to your first part that yes, that one single statement has definitely acted as a change of mood for the markets. And you look at how the markets have been over the last 4 to 5 days. Brutal has been the best word to try and describe the kind of move we've seen for the indices. But then, the second half where, you said that maybe trade deal or the, completion of this deal may not have a positive effect on the markets. I have a slightly different opinion over here because my sense is that the reason for India underperforming with respect to the most of the global markets, and we're looking at this across the globe, not just a certain geography, that it's US markets or Europe markets or Asian sector, it's across the globe where we've underperformed, is because of this overhang in terms of the tariff deal. Once that is sorted out, by that it doesn't mean that it has to be favorable for all sectors, by a huge margin. But even if it gets sorted out, it's a sentiment positive for the markets. So fundamental effects always happen a little bit more with a lag effect. But if the sentiment starts to become positive, that's where I would believe that the markets will start to look a little bit more attractive, less volatile, less uncertain. And I think that itself could be a good ingredient which one should be looking out for. So I, for one, believe that it's a very important event which is lined up hopefully tomorrow. And if that gets cleared, then I believe that the decks for the markets on the upside should also be cleared for a positive effect.
Okay, so that's the take with regard to how you're viewing the Nifty. But talk to us about the breadth, because the breadth continues to remain weak, right, Kunal? So it's not really that we've seen a change of that. Does this genuinely mean that we are at a turnaround, or is this just within the larger cap pack that we're seeing this kind of move? What's your sense, and what does this do if at all something were to come through? Do broader markets continue to sulk?
See, it's a brilliant question, Harsh. Where if you look at the market breadth, 1:5, 1:6 approximately in favor of declines. But then I look at it this way, that most of the stocks till the first couple of hours of trading today, I think by around 11:30 types, were trading with a gash of more than 4%, 5% on an average. Now, of course, to recover from a 4-5% negative to come back into positive will take a lot of effort, not just one piece of news flow. But at least what we've seen is that the percentage downtick for many of these individual stocks, that's shown a very good recovery. And that, I think, is a more important feature to look out for, because bottoms are generally formed not on the best of the market breadth. They are actually formed at a zone where the market breadth is extremely negative, pessimistic. But then there comes a point where the market breadth starts to show signs of recovery. I would believe that today could be a sign where the market breadth starts to show signs of recovery. If there is a follow-through uptick, say by tomorrow or day after, then we can ascertain that maybe the markets have formed a near-term bottom and we could be looking at the index rolling up on the higher side.
Okay, all right. So that's the take coming in, obviously, on the charts with regard to what's playing out. But let's go across to Ravinder. He's got all of the stocks that you want to keep on your radar, and stocks which are buzzing on the back of corporate announcements. Ravinder, good afternoon. What do you have on your list?
Well, yes, good afternoon, Harsh. So let's firstly start with Tejas Network. The Tejas Network is under pressure on the back of their weak Q3 FY26 earning, where company reported a loss at rupees 197 crore as compared to profit of 166 crore year-on-year basis. And if we talk about the revenue, then revenue saw a downtick of more than 88% year-on-year basis. And weak sales have impacted the company's top line during the Q3 FY26. And this is the fourth straight consecutive quarter that company has reported a loss. So back of this, stock is down approximately 11%. IRDAI is buzzing on the back of their strong Q3 FY26 number, where company reported a net revenue at rupees 2,140 crore as compared to 1,699 crore, with an uptick of 26% year-on-year basis. And if we talk about the gross NPA, then company reported a gross NPA at 3.75% in Q3 FY26. So back of the strong set of Q3 number, the IRDAI is also in focus. Tanfac Industries is in buzzing on the back of their order win, when company has entered into a long-term supply contract with a Japanese customer, and the contract covered the supply of 7,500 metric tons per annum with an estimated value of rupees 337.5 crore per year, with an aggregated contract value of approximately 2,362 crore over a seven-year period. Shakti Pump is also in focus on the back of the order win, where company has won a major order of rupees 650 crore, including GST, from the Karnataka Renewable Energy Development. Bajaj Finance is under pressure on the back of the brokerage note, where Bernstein has maintained the underperform rating with target price rupees 750. Some of the solar PV manufacturing stocks is in focus, like Wari Energies and Premier Energies, where China has cut VAT rebate for the exporter from 9% to 6%, causing Indian product to become competitive in the global market. And lastly, some of the export-oriented stocks like Avanti Feeds and Apex Frozen is in focus, where a US ambassador to India said that the next call on trade will occur tomorrow. So back of this, all of these export-oriented stocks like Apex Frozen and Avanti Feeds is in focus.
Thank you for that, Rabinder. And you know, plenty of stocks moving in trade. We take calls from Kunal with regard to some of those. But first, we'll have to take a very, very short break. We'll do that, come back, talk stocks. Stay with us here on ET Now. Welcome back, and at the top of this hour we have big news breaking as IRDAI is set to release the draft rules on insurance commissions soon. They're set to tighten limits on payouts, remuneration, rewards and the like. That's what sources tell your channel. The move follows concerns over sharply rising commissions without matching premium growth and aims to protect policyholders' interests. Anurag Shah here with all of the details. Anurag, what are you catching?
So in coming days, IRDAI is all set to come up with a new draft for the commission rules. So after the Insurance Act amendment, Sabka Bima, Sabki Suraksha, now IRDAI is more empowered to set limit for commission, rewards and remuneration. So as per our sources, IRDAI is working on a new draft notification for commission rules, and in next few days IRDAI will come up with a draft, and with the input of all stakeholders we'll see that new rules for commission and distribution. And as per our sources, the new rules are likely to be implemented from 1st April 2026. We have seen in a FSR report released by Reserve Bank of India the concern raised by RBI about the heavy commission paid by private insurance companies, in which RBI also pointed out that underwriting may get compromised due to high commission given by insurance companies. On the other side, Finance Ministry are also concerned about the increasing commission in FY25 in life insurance space. Commission rose by 18%, but overall business increased by only 6%. So Finance Ministry also sought clarification or asked insurance companies to respond. So new responses already been sent to Finance Ministry, and considering all these development and the more power under the Section 40 of a new Act amendment, IRDAI is all set to come up with new rules for insurance commission and distribution.
I wonder, this is likely to be negative for the only distributor of insurance. Anurag, you track this space closely. Talk to us. Of course, it will be deeply negative for the distributors of insurance. Who else will see the maximum impact on Ram?
So aggregators or distributors like Policy Bazaar as PB Fintechs are likely to get impacted after the new commission rules, because new limits will be decided by the regulator. But main purpose of this new rules is in policyholders' interest, because we have seen there were incidences where commission is going up to the 60%. 70%. So considering all these mis-selling complaints, the new under the Act amendment, Section 40 is more empowered, which now IRDAI can set limit for commission, remuneration and rewards. So previously IRDAI was empowered up to the commission only, and in 2023 IRDAI came up with a new EOM rules, expenses of management, which includes management expenses plus commission, in which complete freedom was given to insurers. But there were many complaints of increasing commission, and companies were acquiring business with a heavy commission. So after the Act amendment and Section 40, which categorically gives powers to IRDAI to set a limit for remuneration, rewards and commission.
Okay, thank you for that, Anurag. We'll let you go. Deepak Shenoy joining us, CEO at Capital Mind Mutual Fund. Deepak, what do you make of these latest, pieces of information coming to us in terms of what the impact of this could be on both insurers as well as distributors? You believe that this will be pushed through, because there's been plenty of debate on it. Which side of the aisle do you sit?
Well, I hope it's pushed through from the consumer side, to be honest, because consumers, in general, insurance payouts are substantially higher than most other financial products in terms of percentage of commissions paid, at least in the first year or second year or so on. So that tends to create a sense of, focus among people who are distributing financial products to favor an insurance product wherever where it is possible. Let's put it this way also, that since the awareness is there both at the consumer end and at the the distributor end of some sorts, and there are very few products that allow you to say, listen, I will take a lower commission, just give a better deal to the customer. There's no way in easily that a customer can or even a distributor can demand that. It's going to be an across the industry rule, and it's going to hurt any distributor or any broker or any player that earns a percentage of that commission or that commission itself down, at least from a cash flow perspective. It may be the same numbers, but it may happen over a period of time rather than a little more upfronting of it, and therefore create different economics for both the employees of the companies distributing it and the companies themselves that are distributing it. Insurers may see lower business because relatively speaking, it takes time for someone to readjust to new and lower commission levels. But by and large, I think the industry will be benefited because of it, not worsened. Because when you do a better deal for customers, eventually more customers come. But that may take 1 or 2 years, and during that time there will be a little bit of a change, and the economic cycle may hurt a little bit more on the distributor end than it is on the company end. Insurance companies are built to last 40-50 years, so therefore I think for them the impact will be a little bit lesser, but the distributors typically have more ongoing cash flow based incentives, and therefore they get affected a little more.
Okay, a few things with regard to insurance that have come through. One was this, of course. The other was the insurance numbers looked quite strong at the outset, and therefore you had some of those life insurance companies doing fairly well in trade this morning. Kunal, any of those on your radar?
I think from the insurance pack, ICICI Pru is something which has done reasonably well. That's a stock which I think for the 3 or 4 consecutive months had done very well, moved up high by more than 15 to 20%. Still looks at an attractive proposition from a short to medium term play, even after the last 3-4 months of a consistent price uptrend. SBI Life, I was taking the charts of the stock as well. Even that stock has come back about 2,100. I think if I'm not wrong today, that stock has also done reasonably well. It was trading in a band of 1800, 1850 thereabouts as a pivot for quite some time in the fag end of 2025. But from there, the stock very recently has managed to pick up a good breakout and come back into a much more higher territory. SBI Life is apparently also a very low beta stock, comparatively. So I think in that sense, the trends are a lot more sturdier for this name.
Okay. And Ruchit Jain also joining us. He's Vice President Equity Technical Research at Wealth Management at Motilal Oswal Financial Services. Ruchit, good afternoon. I'll come to you in just a minute, Ruchit. Kunal, your picks for this afternoon. Let me try and close that one out.
So two buy calls. The first is on Shriram Finance after a correction of almost 40-50 points recently in the last 4 to 5 days. The stock has come back towards a good attractive price point, 965 thereabouts. So look out for a contra buy at current levels, targets of 997, stop loss at 942. And the second would be about Bharat Electronics. So I think that's a stock which have been bullish on. The stock now trading just around that 415 odd mark. So BEL is something which I would recommend as a buy. Targets of 434, stop loss at 412.
Okay. All right. Ruchit, let me come to you. It's been a roller coaster of a market, frankly, last 6 trading sessions. How do you view it, and what's the trend that you make of it, and what's your prediction? How's the week going to go by, in your opinion?
Yeah, hi, very good afternoon.
Very good afternoon.
In the last few trading sessions, we have seen that correction from the all-time high that we touched. So I think the most important thing was the breakdown below that 50 EMA support. When the index, during all the corrections since the month of October, the 50 EMA was acting as a support which got breached on Thursday. And post that, we have seen a continuation of the corrective phase. So I think what today's move is just because of that oversold setups. But until the Nifty again reclaims that 50 EMA, which is now around 25,900, I think that market would be in a corrective phase. So very selective stocks are expected to do well from here on, at least in the short term. 25,900 is the level where the 50 EMA is placed. So until index shows a sustainable move up about 25,900, I think the index would go through some time-wise corrective phase in this broad range of 25,900 as a resistance and 25,300 to 400 zone as the support. So we do not expect any run-up move on the either side in the index. Some volatility would be there, but a broad consolidation phase, I think, is what could be seen in the short term.
Okay, so that's the take coming in from Ruchit. Ruchit, your picks in this market, how would you play it?
So a couple of names, and we are sticking to more with the large cap names rather than going with mid caps and small caps for now. ICICI Bank is one large cap stock that we like at current levels. Off late we have seen the stock showing a relative outperformance compared to other banks in last 1 week. The price up moves have now witnessed good volumes, so this is a good sign. So we expect limited downside from here on. So short-term traders can look for buying opportunities in ICICI Bank with stop loss below 1380 for potential up move towards 1490. And Tata Steel is another large cap name that looks positive technically. In fact, if you look at steel stocks such as Tata Steel, SAIL, even JSW Steel, it just seems that post and up move, the stocks witness some consolidation and are now geared for the next leg of uptrend. So I think irrespective of market move, these are a couple of heavyweights which can do well. Tata Steel, the 20 DMI is acting as a support, so one can go long at current levels with stop loss below 176 for potential up move towards 190.
So those are the picks coming through as well for you. Deepak, let me come to you with regard to Dmart. Now, that as well as, let me try and broad base it. I know you don't talk stock specific. Let me talk retail as a whole. What's playing out? Top line growth isn't matching expectations. Multiples are elevated. Gross margins are expanding, which is causing positive traction both on EBITDA as well as on profitability. So the surprise on EBITDA and profitability has been better than what one would have penciled in. Talk to us about how one should look at the numbers, or what plays out in your opinion in terms of numbers in Q3 FY26 overall within the retail pack, and whether you would play it or not, because multiples clearly stretched. So would you play it through value retail? Would you not play it at all? How should one look at this?
So I think 2 parts here. I think one thing that worries me in a competition intensive sector like retail is the multiples. The multiples are high. There is a tremendous amount of there's in general an overall eating up of margin through competition, and therefore either you lose growth or you can increase margins. It's not it's one or the other, and they've kind of seen one happening in the sense of margins have grown and at the cost of overall growth of the sector. So in my view, what happens is that a lot of competition that's coming into quick commerce and some of the online players spreads the purchasing behavior across multiple players instead of having just one or two. Therefore, any individual player sees a lower growth number, but the overall industry still tends to grow. But at the same time, because your growth factors are, you're losing some of your customers who are buying really small things, and the margins in those small things were also tiny. You are effectively expanding margins on the other products that people are coming to your store to buy. So let's say, if a store was selling both groceries and electronic equipment, just as an example, but you had higher margins on electronic equipment than groceries, and they move their grocery purchases to someone else. Groceries have much lower margin, so you tend to have a margin expansion because more people are buying. The remainder, the percentage buying electronics are higher, but then overall growth is lower, or you sometimes have negative growth in terms of volumes, in terms of actual sales, but your margins expand. This is not useful for a high multiple. A high multiple can only be justified by growth. Eventually, you have to show growth and stable margins. And I think that is the worry here, is that the industry may be looking a lot more at growth from the perspective of or maintenance of margins, and not really focusing on bringing more value to consumers, which is why perhaps at some level this kind of ride will help the retail industry as a whole, but not any individual player from their economics perspective. And therefore, I would need lower valuations to justify my risk in this.
Okay, lower valuations is the call across the board, or higher growth. We'll wait and watch as to whether either of those play out. But what we'll do is slip into a very short break, and we'll continue coverage here. We'll continue to talk stock specific. We have with us Kunal, Ruchit, as well as Deepak. Stay with us, and we'll continue conversation. Welcome back, and plenty of buzzers in trade today, and among those buzzers is Tejas Networks. In fact, the stock is under pressure after the company posted a steep Q3 loss, with revenue plunging nearly 90% on year. The quarter marked its fourth straight loss. Srishti joins in with the highlights of those numbers and putting that into perspective. Srishti.
Well, yes, a dismal set coming in from Tejas Networks this time around, because it is the fourth straight quarter of losses that the company has reported yet again. Though on a quarterly basis, the loss number is seen to be shrinking, but nevertheless, it's a red bottom line that the company has reported with 197 crores of loss. Other than that, the revenue has seen a sharp decline of 88%, and along with that, at the operational front, that is the EBITDA front, the company has reported a loss of 133 crores versus a profit of 371 crores. Now, let's understand the factors behind it. First, of course, is the segments that are not doing very well. And most importantly is the kind of commitment that they had from BSNL, because in this quarter as well, there has been delays in persistent with advance purchase order issued earlier, but the final one is actually pending. And in this particular quarter itself, the company has informed that there's a delay in the receipt of BSNL 4G add-on of 1,526 crores, and that's a huge amount for the shipment of 18,000 sites. So that's one of the key factors that has hampered their top line as well as their bottom line. And along with that, the company on the operational front as well is seeing no improvement at all, because the net debt is seen to be inching higher on a YOY as well as on a quarter-on-quarter basis. 3,300 649 crores is what their net debt stands at. The cash on books is around 500 crores. So that's, of course, is not sufficient. And along with that, they have ended the quarter at an order book of 1329 crores, which itself is a trend that is seen to be in a downward trend. Now, along with that, in terms of the growth triggers, though the company has highlighted some of the growth triggers that the market should be looking forward to, they say that the strong drivers of their business, there's rapid technology transition, and their investments in the AI data centers is driving huge connectivity requirements. And going ahead, they are hopeful for new order wins in these newer segments. So that's about the Tejas Network forward-looking commentary. But for now, it's a dismal set coming in. Back to you.
Okay, thank you for that, Srishti. The other big mover in trade is Lemon Tree, and I'm not sure if it was as big of a mover as the Tejas Networks, but nonetheless, the news is a market moving. It's on the back of the demerger. More importantly, Fleur Hotels, which is going to be one of the demerged entities or companies, and the significant restructuring that's going to likely play out, is going to also attract Warburg Pincus. They're going to be investing in a 26% stake, thereafter investing another 960 crore in equity in Fleur. That is, of course, at the option or a commitment made by Warburg. This move will create two distinct platforms within the Lemon Tree brand. Lemon Tree as an asset-light management company and Fleur as a growth-oriented hotel ownership entity. Snehi joins in with all of the details on that one.
That we heard over the weekend, wherein Lemon Tree is going to be demerging Fleur Hotels from itself to create two very different but complementary brands. What's different here is that Lemon Tree is going to be an asset-light brand going ahead, focusing only on hotel management services, and Fleur Hotels is going to become an asset-heavy, completely newly listed entity in the next 12 to 15 months. That's the timeline that the management has given. But yes, this is going to be the arm that owns and operates all the hotels and all the future leases, any future developments, any asset-heavy development basically will now fall under Fleur Hotels. Warburg Pincus here is going to be acquiring APG's 41.09% stake in Fleur Hotels before this composite scheme is completed. So this marks the complete exit of APG from Warburg Pincus, from Lemon Tree as well as Fleur Hotels. Let's understand what the steps of the demerger are. Lemon Tree is going to be merging two wholly owned subsidiaries, Carnation Hotels and Hampstead Living, with itself, after which four wholly owned subsidiaries of Lemon Tree are going to be then demerged to Fleur Hotels, for which Fleur is going to be issuing equity shares to Lemon Tree. Now we don't know what is the share swap ratio over here, which makes it very difficult to evaluate this entire deal. And 12 hotels and exclusivity on all future developments, ownership and leasing of hotel assets are going to be merged into Fleur Hotels as well. Let's understand what the shareholding structure is going to be. Lemon Tree shareholders will directly and indirectly hold about 74% stake in Fleur. Shareholders are directly going to be holding 32.9, so that's almost 33% stake in Fleur, plus the overall entity Lemon Tree is going to be holding 41% stake. Warburg Pincus will own the balance 26% stake in Fleur Hotels. And all Fleur Hotels assets will now operate under the new hotel operating agreements from 1st of April this year. So Warburg Pincus is going to be acquiring APG's entire stake, like we told you. Fleur will get an initial investment of 960 crores. But remember, this is not Warburg's first time investing in Lemon Tree. They had done so in 2006. So this is their round 2 in Lemon Tree as well. Fleur's portfolio post demerger owned portfolio will increase from 3,993 keys and 24 operating hotels currently to 5,813 keys, all the way up to 41 hotels. So 17 hotels and 1820 keys are being moved from Lemon Tree to Fleur Hotels, to put it very simply, and these will be owned by Fleur but managed by Lemon Tree. Lastly, what's next for this demerger scheme is subject to shareholder and regulatory approvals. Fleur Hotels is going to be listed separately on the Indian exchanges, and this entire process could take 12 to 15 months. So yes, all eyes are on Lemon Tree on the back of this demerger announcement.
All right, thank you for that, Snehi. Deepak, give us a sense. Hospitality. Warburg's betting big with regard to hospitality. Are you also seeing signs of this cycle continuing with probably a renewed vigor?
I think the hospitality sector should actually do really well. There's a bit of capex that has to come now in the next 2 or 3 years, and that capex is going to drag operating margins to some extent, but also cash flows to another extent. and debt-related changes in many of these hotels. Now going asset light at a time when asset expansions, some of the other players are going down the asset owned route may not necessarily be useful in the longer term, because I think portfolios will change, at least from the hotel sector. The portfolios will change more towards developing properties. I think eventually owning properties will be a better way to go in India at the moment. So some of the larger, more premium hotel chains are quite interesting. The smaller ones, I think the competition there is intense. There's a lot of unstructured competition as well. There is a fairly large amount of availability in India. The availability structures have changed in the last year or so, and you're not seeing that much growth in the non-premium segment. The premium segment is growing very well. So I think that's where the focus has been. The hospitality sector in general should expand a little more if we're getting into pleasure cruises, for instance, and few other places, few other sectors in the tourism areas, and we will see a lot more. We will see a lot more happen in terms of capex expansions. So therefore, I am a little wary of paying too much, but I think this is a good sector to have for the next 10 years. It will grow quite substantially from here. There might be times to buy some of the smaller players also. I think they've come down in valuations, but not down enough. They will be. There's a good time. I think you can kind of think of an SIP into the sector. This is a good time to do it, because I think there will be lots of opportunities that will come in the next year or so to be able to make bets for the longer term.
Interesting. And Deepak, if I were to request you to pick one sector or segment which you're most bullish about in calendar year 2026, what would it be?
I suppose I can't, favor, because I don't know what will happen. But if you ask me, the manufacturing sector in general, specifically around electronics, that still seems to be the biggest bet. Defense, I think, is going to come back in a very big way. We'll have to address some issues. We'll have to address government finances. We'll have to see how the budget comes out. But I think that is another big sector. The third one is financial infrastructure. So I think India is doing very well on that in terms of domestic participation in financial investments and insurance and payments and even in lending. I think financial infrastructure players will do very well in this year, but they're like a little bit further down the cycle here, because we've had 2 or 3 good years behind us. There may be some period of consolidation before the next move. However, I still think they're a good, they will perform well in 2026.
Thank you so much, Deepak, for joining us, giving us that perspective. We'll let you go on that note. Thanks so much for coming in and speaking with us. Kunal, if I were to ask you what's playing out in markets at this point, we're 100 points higher on the Nifty, which is a positive. From the lows of the day, of course, we've done extremely well. I don't think too many people would have called the kind of move that the Nifty has made.
Absolutely.
But we're not seeing that in broader markets. Is that a concern at all for you?
No, it's not a concern. And Harsh, as I was pointing out earlier, that today in the first couple of hours, there were stocks which are down 4%, 5% on an average. Now, for these stocks to even come back into closing flattish negative, maybe a 1% down, I would still believe is a very good sign of a recovery on the overall market breadth. We were almost at 500 towards advances and 2,500 towards declines. We are almost at 1,200 advances right now towards 1,900 declines. So it depends on what matrix you are looking at. If you're looking at this on a relative basis, then of course we've done very well. If you're looking at this on an absolute basis, then of course there will be some scope of disappointment that the markets have gone through a third or a fourth consecutive day of a negative market breadth. I choose to do it on a relative basis, because today the first couple of hours have been completely different than the next follow-up couple of hours for the markets. We've seen a very good recovery, a solid base which is now established at the 25,500 levels for the index. Remember, we are just, I think, 100 points off from 26,000 mark in futures. So that itself tells you the kind of scope of recovery we've seen on an intraday basis. So I would believe that it's a very good recovery, should have more legs on the upside.
More legs on the upside, very good recovery. Ruchit Jain, I know you're bullish with regard to Tata Steel in particular within the metals pack. Anything else within metals that's standing out? Do you believe that the whole pack is set for a rally, or do you believe it's a Tata Steel specific call that you've made?
I think the steel related names would do well, be it Tata Steel, Steel Authority, or even JSW Steel. This is one space which relatively is yet to see that catch-up move compared to the other base metals that we have seen. So I think SAIL would be another stock. If one has to create fresh longs from the metal space, then one can go long over here.
Okay, so SAIL and Tata Steel. Ruchit, stay with us. Viewers, stay with us as well. Ashi Anand is going to join us on the other side of this very short break. We'll continue conversation here on ET Now.
AU सेविंग्स अकाउंट में मिलते हैं अमेजिंग बेनिफिट्स, पेपरलेस बैंकिंग एंड हायर इंटरेस्ट, वो भी हर महीने।
मनी 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 एवरी मंथ। सोच बदलो और बैंक भी।
Welcome back. Joined by Ashi Anand, founder and CEO at IME Capital, and he's joining us this afternoon to give us his views. Ashi, this rally in metals that we're seeing, if I can call it that, at least today, but even when we look at the last 12 months, metals have been outperformers. Now, whether you call it base metals, whether you look at the steel pack, all of them have outperformed in significant fashion. If I even look at Tata Steel over the last 12 months, it's done very, very well for itself. And Nifty 50 counter, not a base metal either, not linked to a copper, not linked to some of the others. Your sense with regard to the rally in metals and whether that's sustainable or not?
Yeah, sure. So actually, metals is really quite broad, right? And you really need to kind of break up kind of metals into precious metals, some of the base metals, and even within base metals, kind of there are different underlying kind of demand drivers for steel, for zinc, for copper, etc. So just kind of looking at each of these independently, I think what you have seen in the precious metals pack, and this is kind of gold and silver, where you have seen substantial up moves and were probably the big outperformers in terms of an asset class last year. This has really moved up largely on account of kind of geopolitical kind of concerns. And I think a very large amount of this move does appear to be done. In any very strong bull market, it is always very difficult to kind of call the top of a bull market. And some of the underlying kind of demand drivers as geopolitical kind of concerns, the fact that central banks are wanting to kind of increase gold holdings to de-risk away from the dollar, the fact that there is increased investor appetite. Very often towards the end of a bull market, you don't really see as in you still see very strong demand tailwinds. So I kind of like on gold and silver, we are aware that there is extremely strong momentum, but we are kind of a bit more cautious because you've already seen a very large part of the move. So I kind of gold, silver, you're a lot more cautious out there. When it kind of comes to metals, we are a little more positive on certain materials that go into kind of electronics and electricals. So things like copper, some amount, to some extent, aluminium, zinc at some level. What you are seeing is very, very strong AI capex that is going to come in over the next decade. And for a number of these metals, there is an incremental kind of a driver that this is adding, and they are kind of supportive of AI capex is kind of quite supportive of incremental demand generation out here. Not all metals are as kind of favorably positioned there, and which is where you need to look at them individually, as well as there are certain very important underlying kind of supply dynamics. Copper has seen very significant mine shutdowns, which has led to this very sharp rally that you've seen. As those mines come back, you should see kind of copper settle down a bit. So kind of we are a bit more positive on this set of metals where there is this longer term AI kind of demand driven growth. Steel is something we are a bit more cautious about. Steel it's still very infra or kind of auto or consumer goods or housing kind of driven. The biggest market, which is China, you aren't seeing very strong demand growth drivers coming in from there. Now, until you don't get a lot more positive about the Chinese economy, we kind of see steel have a bit more of a cautious view on the steel pack.
Okay, so that's the take, in fact, coming with regard to metals. Thanks for that, Ashi. I wonder, Ashi, if you also have a view with regard to IT, because that's the pack which will be in focus on the back of earnings. And you have a very keen eye on ground with regard to technology as a whole. I wonder how you're seeing the entire evolution of the IT space as AI kicks in a more significant fashion and is more broad-based now. How should the IT companies actually catch up? Who will the differentiators be? Who will the winners be? How should one identify that?
Okay, sure. So let's first differentiate IT very clearly into very distinct segments. One, you have digital platforms or tech plays, which are actually apps or platforms that have been created for the Indian consumer. This, as you'll be well aware, we've discussed this multiple times in the channel. We believe that this is the theme for the decade. We have a fund which focuses exclusively on the space. This was launched in February 23, done incredibly well since then. But we still believe that we're still in early stages of this larger structural move. This decade is likely to see sustained kind of value migration away from traditional businesses towards new age digital tech firms. And as kind of these companies continue to scale, we also see profitability and cash flows improving substantially. And this combination of kind of growth as well as kind of improved profitability is really a very, very strong recipe for value creation, and which is what makes us so bullish on the digital tech space. Now, if you're looking at IT services, that is actually quite a different story. IT services being the traditional IT companies like your Infosys and TCS, which are servicing global IT demand. Out here, there are 2 or 3 factors which are all quite important to look at. In the near term is firstly what's happening in terms of a demand recovery coming in from the US. Tech spends or IT spends from the US have been fairly weak over the last couple of years. You are expecting to see kind of an improvement as the economy starts to kind of come back. So that is kind of the key near-term driver. However, the moment you're looking at IT services, understanding the impact AI is going to have in the space is very, very important. There are two key impacts. Firstly, as kind of AI becomes a bit more mainstream, we are expecting fairly large enterprise-wide AI kind of projects coming in, where larger enterprises are trying to incorporate AI into their overall kind of tech stack. We see Indian IT companies being very well positioned here. And as you go into FY27 and 28, this should be quite an important, interesting incremental kind of demand driver. You're still probably 2 to 3 quarters away from this being substantial, but we clearly see this as an interesting tailwind. On the other hand, AI is also going to be used quite substantially by these companies in order to increase the productivity of their labor force.
Right.
Now, because they need to pass on some of these cost benefits to the clients, this is likely to have a deflationary impact. You're therefore likely to see revenues possibly not grow as much, but improvement in margins.
Sure.
And therefore, profitability should be decent.
Sure. Okay. All right, Ashi. We'll pause there. Ruchit, Kunal, will come back to you straight after this break. What we're going to do is quickly look at what Pradeep Kumar Das, who's the Chairman Managing Director of IRDAI, said with regard to future outlook. Listening to an excerpt of that conversation, we'll slip into a very short break. On the other side, we'll continue conversation. Stay with us here on ET Now.
The growth momentum is there quite steady since 25 quarters, not just 1 quarter or 2 quarters. Only the provisioning and NPA issues which will become alarming in the last June quarter. And we all know that is largely because of Gensal and another group of material. And if you see in the country, the RE is growing at a CAGR of 22.6%. And our loan book is growing at 28% of CAGR, almost 27-28%. That's why. Finally, if you see that throughout the year, the market could have had some ups and downs in the review, but finally 49.12 gigawatt is quite encouraging figure. That too, when the government has said in the beginning that we'll make 50 gigawatt. And we have to have 485 gigawatt of RE by 2030. And that we can achieve by financing till 2028 or 29.
Gold and silver hit another record high after the US Justice Department threatened the Federal Reserve with a criminal indictment, reviving concerns over its independence, while protests in Iran supported heavy demand. Oil holds on to its biggest two-day gain since October as escalating protests in Iran threaten supply from OPEC's fourth biggest producer. Brent crude is now trading above $63 a barrel after jumping almost 6% over Thursday and Friday last week. Copper rose towards a record high as base metals start the week on a strong note, aided by concerns over supplies and a weaker dollar. 3-month copper futures rise as much as 1.5% to $13,195 a ton in London as aluminium and tin are now trading at the highest level since 2022. Palm oil stockpiles in Malaysia surged more than expected last month, surpassing the 3 million ton mark for the first time in 7 years as production dropped less than predicted and local demand weakened. And in other global stories, China is restarting soybean auctions after a 3-week pause in an apparent attempt to clear storage space as it keeps buying from the US following the trade truce between the two countries. Welcome back, and the big story this week will be earnings, and TCS will kickstart the earnings season. It's especially within the Nifty pack with steady expectations this time around. Revenue is likely to be flat while wage hikes, furloughs, excuse me, and the BSNL ramp up may weigh on margins. Ashesha joins in, or rather Ishika joins in with what to expect.
That's right. So TCS is going to come out with its Q3 results today, and here are some of the expectations of the markets from its earnings. So firstly, the market is expecting revenue growth in terms of CC terms at 1.6%. However, in US dollars, they're expecting flat revenue in comparison to last quarter, and EBIT margins, we're expecting it to be up 1.1% and PAT to be up by 7.7% this quarter. Now, in terms of expectations for this quarter, we are expecting inorganic contribution from the List Engage acquisition that happened last quarter. Now we're expecting contribution to be at 0.1%. We are also expecting 2-month impact of wage hike furloughs to weigh on the EBIT margins. Now another factor that will be impacting the EBIT margins would be the steady ramp up of BSNL deal and redundancy related costs, as well as TCV we're expecting to be between $10 to $11 billion. Now in terms of what to look forward to or what to monitor once the results are out, we should track management commentary on demand and measures taken to accelerate revenue growth as well as wallet share. Now we should also track a deal pipeline and the overview of client budgets for CY 2026. And towards the end of last year, during the analyst day of TCS, they talked about Gen AI numbers and quantifying them. So they will be talking about key metrics to track that as well. Very important to track. And amongst other things, we should look at GCC ramp up and Europe, UK healthcare segments as well. Back to you.
Ishika, we'll come straight back to you with regard to HCL Tech. What do we expect on that count from Q3?
So while other IT companies are expecting a seasonally soft quarter, HCL Tech is different in terms of that because of its product share in its offerings right. Now in terms of revenue, US dollar revenue, we can expect it to be up by 2.2%, whereas INR revenue to be up by 4.5%. And talking about margins, we can expect EBIT to be up 8.2% this quarter, and PAT we can expect it to be up by 11%. Now in terms of what the streets are expecting this quarter, we're expecting CC growth at 2.3% and seasonal tailwinds that we talked about, especially coming from the products of its offerings, which will aid in the growth. We can also expect a TCV of $2.5 billion going ahead this quarter. And to sum it all up, this will be a seasonally better quarter for HCL Tech especially, and margins will do well by 70 to 80 BPS on account of wage hike impact as well as furloughs. Now, in terms of what segments to track, we have to track BFSI as well as high tech, which are expecting to perform much better as compared to last quarter. And now, another thing to note here is that HCL Tech has guided for a guidance reduced to maintain to 3 to 5%, and services revenue growth have been revised to maintain at 4 to 5% as well. So we're expecting a good quarter for HCL Tech, and back to you.
Of course, you can catch the earnings conference calls coming through with regard to HCL Tech, and we will keep you updated with regard to TCS as well, and all that's likely to play out. So plenty of action this evening and impact of that tomorrow. Ruchit, let me quickly take a view from you with regard to the IT pack. Would you at all play within any of those names within IT? Is that something that you're actively looking at? Anything looking attractive on charts at this point?
I'll wait for the numbers and the reaction of stock prices to the numbers. We have often seen that the quarterly numbers set out the momentum for the next 2 or 3 months. So I think given that the IT space has recently seen more of a time-wise correction or consolidation, any momentum post the numbers will give more clarity as how the short to medium-term trends would set out. So I think post numbers itself, one can look to create new positions.
Wait for the numbers to come. Kunal, would you also recommend the same? Wait for numbers?
Yeah, see, logically, of course, you'll have to wait for the numbers because you don't know for sure that which stock would be an outperformer. But you also have to look at a point where the IT stocks will sooner or later go into a turnaround. The underperformance which was there for major part of 2025 or the first, I think, 3 calendar quarters, if I can speak so, for the IT stocks, that started to show signs of turning in the fag end of 2025. So I, for one, believe that maybe there may not be a significant room of disappointment for the stock price. But for the stocks to move up higher, they would need to deliver returns which could be a little bit more above the market expectations. Only then you can expect a meaningful turnaround. I would actually believe that this could be a good zone where large cap IT stocks may be considered as a good turnaround space. So if, for example, if the numbers say slightly disappoint and the stocks are off by a couple of percentage points, I believe that's a fantastic opportunity for someone who has a time frame of at least 3 to 4 quarters or more to chip into these IT majors.
Okay, interesting take. Kunal, I also wonder what your take with regard to Asian Paints is. This has been a stock which has shown remarkable resilience last week, and now, given the rally in the index, we've seen a 2.6% move on an Asian Paints today. What next?
I'm very bullish on the stock, Harsh, and for multiple reasons. One is, of course, the stock being a huge underperformer. First, in the last 2-3 years, 2021 or 22 is where the stock had topped out at 3,500 mark. Took almost 3 years or 4 years for the stock to go into a correction. So a completed time-wise, price-wise correction, came back towards 2,300 levels and now start to show signs of recovery. And we've seen historically that when stocks retrace almost 50% of the entire correction they have gone through in a period of the last 2 or 3 years, the scope of recovery on the medium to long-term charts improves significantly for these names. So on the back of this, on the back of recent recovery, I would believe Asian Paints could be a good turnaround candidate from current levels. And I won't be too much perturbed also about the oil price hike for, oil price rise if it happens over the near term, because I believe major part of the pain for that has been factored into Asian Paints. So I think even that, may not play a dampener for the stock price. So bullish on Asian Paints and expecting the stock to go into a major multi-year uptrend starting maybe previous quarter.
Ruchit, Coal India. By the way, the subsidiary of Coal India, Bharat Coking Coal, the listing has seen a frenzy in terms of the IPO itself is now 25 plus times oversubscribed. Ruchit, with regard to Coal India, I mean, you've seen a surge in the stock price since this announcement. In fact, we've seen remarkable uptick with regard to the stock price. What next with regard to a Coal India on charts?
This breakout which happened on 23rd of December was a breakout from about 1 year of consolidation phase for Coal India. And post that move, if you look at the volumes, then the volumes have increased gradually compared to what we've seen in the last few months on a daily basis. I think this clearly indicates that the stock has shown signs of a renewed uptrend after this time-wise corrective phase. On the higher side, So considering that the stock is also forming a bullish flag pattern on the daily chart, it has potential to head higher towards 455, 460 kind of levels in the near term. So definitely the trend remains bullish. Any existing longs should be held on for potential targets around 460.
Okay. Ashi, within the IT basket, how would you play traditional IT?
So I think the main thing is, firstly, we do need to see the results. I think as important as the actual results are going to be what management commentary is. We kind of prefer, just given where valuations are, we see a lot of value in the mainstream large cap IT. So both Infi and TCS are both very, very attractively valued. We are aware that mid-size IT may have higher growth potential, but from a value perspective, we find both Infi and TCS very compelling. I think the other element around traditional IT services is the whole ER&D space, which has been under pressure for the last couple of years because of kind of just slightly weakness, some amount of weakness in even kind of EV ER&D demand. Unlike traditional IT services where levels of penetration is a lot more, I think there's a multi-year penetration story that is to play out in ER&D services. And therefore, from a slightly longer term perspective, we find ER&D a little more attractive than traditional IT.
Okay, ER&D over traditional IT. And Kunal, the move on PFC, REC, IRDAI, that entire pack, has that caught your eye? And would you at all bet on any of these names?
Yeah, we were discussing in the morning about PFC and REC. I maintain that these stocks are worthy of being part of your longer term portfolio. So I think it comes as a good move that these stocks are up 3%, 3.5% broadly so far today. I also believe that the recovery that these stocks have shown from their December lows, 330-ish thereabouts, respectively for both PFC and REC, and the recovery post that towards 380-ish kind of a zone, I think it was quite a class recovery for these stocks. And this is where I would sense that long-term uptrend will start to shape up quite well. And remember, I think for the last 5 quarters, these stocks were into a downtrend. So you can't have a point where these stocks may keep on underperforming quarter after quarter. And if there is a scope of recovery for these stocks, it may not be a meager recovery for these names. So in whichever way we look at, I think over the next 3 months to 6 months at least, there could be a very strong scope of a recovery for both PFC and REC. I'm very bullish on both of these names.
Very bullish with regard to PFC, REC. Okay. We caught up with, in fact, Manish Garg, CEO of Interarch Building Products, to understand how volume growth is set to outpace turnover, and that's driven by expansion of new plants. Listen in to a slice of that conversation. Stock up 6%, by the way.
If you see, our volume growth has been a bit higher than our turnover growth. So turnover growth really depends on, quite obviously, your volume growth, but then also on the steel pricing that plays out. So in terms of our installed capacity, we are definitely utilizing much more of it. We are ramping up very, very quickly on our new plants, which is the expansion that got commercialized in our Uttarakhand plant with a new capacity addition for the box line. And in Andhra, where we commercialized the phase 2, which is very fast ramping up. So yes, the volume growth is going to be a function of our capacity utilization going even beyond 88 to 90% during the H2 of this financial year.
Okay. Ashi, I wonder how you play some of the hard infrastructure names. Would you play through prefabricated infrastructure like an Interarch? Would you play it through maybe a different manner of playing it? How would you play hard infrastructure, and how would you play real estate? Give us a sense of that.
A little more positive on real estate over hard infra. I think on hard infra, one important element to understand is that the government is shifting a little focus back towards revenue expenditure. What you did see over FY23 and FY24 is kind of capex significantly kind of outpaced revenue expenditure. But post kind of the last general elections, you have seen the government starting to kind of prioritize consumption and kind of pleasing the consumer a bit more. Now, in an environment where kind of you've had income tax cuts, you've had GST cuts, etc., we're not sure on the sheer quantum of kind of growth that you're going to be getting off an already high base in hard infra, and which is why we are not as optimistic here as, say, we were a couple of years ago. On real estate, while the stocks have also moved up quite substantially from effectively their lows, we do believe that you're still kind of somewhere in the mid of possibly a multi-year growth revival cycle. You have multiple underlying kind of strong demand trends. You have kind of consumer demand, you have a shift away from unorganized to organized. COVID has actually led to much higher aspirations in terms of the quality of houses that people want. And all of this is kind of playing out quite favorably in favor of listed real estate companies. So I think real estate is kind of our favored way to play the kind of overall fixed capital formation in the Indian economy.
Okay, all right. Ruchit, let me ask you a quick take with regard to the pharma basket. Is there a view you have there? Is there a tilt? Are there some stocks which you're keeping on your radar?
I think selective stocks can do well where there is a higher top, higher bottom structure. And one of that stock from the pharma space, which we have even recommended to our clients, is Alchem Laboratories. Irrespective of what last couple of trading sessions we witnessed a broader sell-off, we did not see any kind of selling pressure coming in this stock. And with just a minor momentum turning positive, the stock has shown a good outperformance. The stock has even touched its 52-week high today again. So price volume action seems quite bullish over here from a trading perspective. One can go long on Alchem Lab at current levels with stop loss below 5,770 for potential targets around 6,000, 6,050.
Well, thank you so much, Ruchit, as well as Ashi, for joining us. We'll let you go on that note. And as we start wrapping up, the Nifty IT index has made a full recovery from the day's low of 37,600 odd. 1,500 point recovery is what it looks like. Nearly 2,000, 1,500 point recovery. I beg your pardon, 500 point recovery. I beg your pardon for that. But Ashesha here with all of the action from the day. Ashesha.
Well, yes, we were under pressure earlier in the day, but after that comments that came in from US representative to India or US ambassador to India, who said that US-India trade talks are underway and the outcome is expected tomorrow. After that, we have seen sharp recovery in Indian equity markets. Nifty is ending 116 points higher for the day, near that 25,800 mark. And as you mentioned, we have seen solid recovery for the Nifty Bank as well. At one point in time, we were below that 59,000 mark, but we are ending near that 59,500 mark. That's the kind of recovery that we have seen on an intraday basis today. Let's put the spotlight on some individual stocks which were in focus today. Something like Infosys, which will be reporting its numbers on 14th. That one was the biggest loser from the Nifty 50 pack. Despite the recovery, the stock is ending nearly 1% lower in trade. Tata Motors, PV and Bajaj Finance were also some of the other losers from the Nifty 50 pack. On the gaining side though, Coal India continued to buck the trend in today's trading session as well. Coal India should come up for you on your screens. That one was up nearly 3.5%, the biggest gainer on the Nifty 50 index. Asian Paints and Tata Steel were also gaining in trade today. In terms of other newsmakers, let's talk about real estate stocks because they were under pressure today. Something like Signature Global, because they said that they will not be able to achieve their guidance for FY26. That stock is ending 5.5% lower. Prestige Estates, DLF, Godrej Properties, all of these stocks ending the day with some amount of decline. So yes, we had a whole host of buzzers which were reacting to updates to their results. But on the index level, we did see a sharp recovery by the end of today's trading session. Harsh, back to you in the studios.
Well, thank you so much for that, Ashesha. Kunal, 210 points is what we fell by in the morning. And we closed 119 points above yesterday or Friday's close. So Friday's close down 210 and thereafter we've closed up 119. That's a 330 plus point move in a single day of trade. What do you make of it?
Of course, it's been a fabulous recovery. To put it very simply, it was a brutal market at the start, and to close a brutal market into a much more positive intent was the hallmark, I think, of the trade today. The fact that we've managed to hold on somehow around the 25,500 kind of a zone on the index spot levels, that I think is another achievement for the index. And I always believe that corrections, they generally create doubts, but recoveries are the ones which start to create trends. So I think what we may see from here on, assuming if the news flow doesn't deteriorate for our markets, that we could be on the path of a very strong recovery, and that will by itself unfold or a lot of strong trends within sectors, within stocks. I think that's something which one needs to watch out for. So maybe I think a major part of the correction, the intensity of the correction, I think could be behind us, and our markets could now be a lot more stable.
We'll also have the CPI print to watch out for tomorrow. We'll also have the trade talks, and we've seen a 317-point run today from the day's lows. We started off with Kunal looking visibly negative at the start of the day to now Kunal looking visibly positive. So all things looking good. And we'll have the IT earnings, of course, in focus, which will likely drive markets or rather determine the direction of markets tomorrow. So that's something you want to look out for. But stay tuned. All of the live action continues here on ET Now. But for the moment, it's the end of this show, Closing Trades. From me and everyone who puts this show together, thanks so much for watching. Stay with us here on ET Now. Live action continues. It's going to be a packed evening.